What's a bank statement mortgage for self-employed borrowers? Hey, what's going on, everybody? It is Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching today. I really appreciate you guys checking out my show. And today what we're looking at is self-employed borrowers. And in another show, I talk about the traditional way to qualify people with self-employed mortgages. I'll put that link somewhere here in the video. But one of the really cool things about being self-employed is that you try to benefit from the best of both worlds. And what I mean by that is that when you're self-employed, hopefully you have a really good accountant that's helping you minimize the amount of tax that you pay on the income that you bring in as a self-employed person. So that means that you probably have a good accountant. That accountant's going to help you, get the appropriate write-offs that you need. We're not breaking any rules or any laws or anything like that, but you are have a benefit to be able to write that stuff off. Whereas, people who are not self-employed don't have that same benefit that you do. So you provide an important service. You're a small business owner in this country. So there's a way that we can usually qualify you for a mortgage, and you want to try to benefit that by paying the least amount of tax possible. Well, when you're borrowing mortgage money, we only allow you to qualify for the amount of income that you actually pay tax on. So if you have a really good accountant and they're writing off a lot of stuff for you, it may not be the best way to get a mortgage in that particular instance. But here comes this extra program that came around several years ago that is super beneficial for self-employed borrowers, and it's called a bank statement loan. So the traditional way to qualify you as a self-employed borrower is to look at your personal tax returns and your business tax returns and determine how much income is coming in and out of the business, factoring in all of the expenses that you have, and then figuring out how much money you pay taxes on. Well, the alternative for a bank statement loan is to look at the amount of money coming in through your bank statements over the last 12 months, whether it's a business bank statements or personal bank statements, depending on how you hold your business entity, whether it's a sole proprietorship or a LLC or a S Corp or a C Corp or a partnership. We need two different sets of documents there. If you're sole proprietor, then we would look at your 12 months of your last business bank statements or personal bank statements. And then the same thing, if you have an entity that you formed for your small business, we would have the last 12 months of your business bank statements. We can actually go up to 24 months, which just shows even more stability. So if you have 24 months worth of bank statements and they're pretty consistent, the amount of deposits that you have that bring in, that might actually even be better than just the 12 months. But 12 months is the minimum that you need. And what we're going to do is we're going to look at all that income coming in from that, and then we're going to use what's called an expense factor ratio. And it's usually 50% of the amount of money coming in, expense factor ratio of 50%. So we're going to divide all that income by 50% or divide by 2 to figure out what your income is. Now, if you have less expenses on that and you can verify that, we can usually get a CPA to verify that for us that, hey, look, my expenses are way less than 50% of the money coming in. And all we need is a CPA letter from your CPA saying, hey, look, our expenses are 25%, let's say. Okay, that's usually as low as we go in terms of the expense factor ratio. We don't go lower than that for most businesses, but 25% is a lot better than 50% for an expense ratio. So I would take that all day long if you pay less than 50% in expenses for your business. Okay, so we're going to use that money that comes in through your bank statements, the actual deposits themselves, and we're going to use that expense factor ratio to figure out how much income you have. Everything else on the loan documentation you need is exactly the same. So that means your asset statements. So looking at your bank statements or any financial accounts that you have that are investments, things like that, to show what your assets are, and then also your credit and things like that factor in as well. Okay, credit and liabilities factor in as well. So for the most part, the only thing that we're doing different here on a bank statement loan is that we're using your bank statements for your income rather than looking at your tax returns for income. So what I love about this is that there's a lot more flexibility in the amount of money that you can qualify for this, because hey, if you're in business again, you have probably a good accountant. So I do love these types of loans. But because of the flexibility, here's some of the drawbacks of using a bank statement loan. So number one, rates are usually a little bit higher, usually anywhere from 1 to 2% higher than what a traditional primary residence mortgage loan would be for like a Fannie Mae or Freddie Mac or most jumbo type products. So interest rate's going to be a little bit higher because of the flexibility of that you get to pay for. So Second drawback is that you usually need to have a little bit better credit. So a minimum of 660, can't really go much lower than that. But I would say that 700 is probably a preferred credit score for you to have when you're doing a bank statement loan. You usually need reserves regardless of the loan size. So when we're doing loans for primary residences on Fannie Mae and Freddie Mac and FHA and VA, oftentimes we don't need reserves. So we don't need any extra money left over in the bank when we're done. But when we're using the special way to qualify, you're going to need reserves. And it's usually anywhere from 6 months to 12 months. And I've seen it as high as 24 months with some different investors. So make sure you have a little extra money when you're going to be doing these bank statement loan qualifications. And then down payments on these are usually 20% or more. So this is called a non-QM mortgage, non-qualified mortgage. It doesn't fit into the traditional income guidelines of a Fannie Mae loan or a Freddie Mac loan. So we're going to call it non-QM, and you're usually going to need 20% or more. However, they could go down as little as 10% on these bank statement loans, which I think is pretty cool. And then the last thing, DTIs are usually going to be a little bit lower. And what I mean by that is that with traditional loans, you can usually go up to 50, in some instances, 55% debt to income ratio. But with these bank statement loans, we're looking at usually 43% or less for the most part for most of them. Some of them go as high as 50%. But again, there's an added layer of risk in there when you go a little bit above that 43% debt ratio there. And then lastly, on these types of loans, ARM loans are a lot more prevalent, whereas on conventional loans and then government loans, for the most part, 30-year fixed is all you're going to be able to get. But for these ARM loans are a lot more prevalent than the 30-year fixed mortgages. Okay, so those are some of the drawbacks of getting a loan with the bank statement program. But I still love them with the flexibility that you have to be able to qualify with the income and the deposits coming in versus just the tax returns. I really like this as a solution for self-employed borrowers across the country. So if you are a self-employed person and you are looking to get a house somewhere in this country, I'd love to be the one that helps you out. Please make sure that you reach out to me. I'll put my Calendly link down below. So if you want to click on my calendar, find a time to chat with me, and we can go from there. And I'd love to be the guy that helps you out to get your next house if you're self-employed. So thanks so much for watching today. If you guys have any questions at all about bank statement loans, feel free to reach out to me, and I look forward to chatting with you on the next show. Have a good one. Bye.